Some news, maybe an update, and it seems to tell two completely different stories at once, like a riddle you have to solve just to figure out what's really going on. Well, that's exactly the kind of puzzle we're tackling today. Our deep dive today is all about the June 2025 U.S. Consumer Price Index report, the CPI. And look, this wasn't just another data drop. This report sent out really specific and frankly kind of conflicting signals to global markets and, importantly, to the Federal Reserve. Its ripples, well, they touch everything from interest rates to the U.S. dollar's strength and, yeah, ultimately, your financial world.
Absolutely. And our mission today is really to cut through that complexity. We're going to pull out the most important nuggets, the key insights from the CPI report, helping you understand not just what happened, but why it actually matters for the big picture, for the economy.
Yeah, the source material called the signals bifurcated and nuanced. I thought that was such an interesting phrase. It really sets up the core tension right away, doesn't it? So, okay, let's unpack this. Bifurcated and nuanced inflation signals. What did that actually mean in plain English?
Well, it really boils down to a core contradiction in the numbers. On one side, you had headline inflation speeding up. It hit 2.7% year over year. That's its highest reading since February. And it was mostly pushed up by, the volatile stuff like energy and also those new trade tariffs kicking in. So that sounds pretty hot, right? Makes you think inflation's taking off again.
Yeah, 2.7 definitely gets your attention.
But, and this is the crucial but core inflation, the measure the Fed prefers because it strips out food and energy, that actually came in softer than expected. It landed at 2.9% year over year. The market consensus was looking for 3.0%. So it missed slightly, but importantly.
Okay, wait, let me get those numbers straight. Headline was 2.7%.
Yep, 2.7 year over year, which was kind of in line or maybe a hair above forecast. Headline month over month was 0.3%, right on forecast.
Got it. And core?
Core year over year was 2.9% versus that 3.0 forecast. And core month over month was 0.2% when the forecast was 0.3. And, that softer core month over month reading, that's actually the fifth month in a row it's come in below expectations. So that really suggests that the underlying domestic price pressures, especially things like shelter costs, are genuinely starting to ease off.
So it's like the engine room is cooling down even if the smokestack looks fiery because of external stuff like tariffs?
That's a great way to put it. Exactly. Two very different signals coming from the same report.
Okay, but if the Fed mostly cares about core inflation, why the big reaction to the headline? Is there a risk the market's maybe, I don't know, overreacting to the noisy part?
That's a really insightful question, and it gets right to why this duality creates what you might call policy inertia for the Fed. In a strange way, this data is almost perfect for them right now. It's not weak enough to make them panic and cut rates immediately, but it's also not nearly strong enough, especially that core reading, to make them think about hiking rates again.
So it lets them stay put.
Precisely. It validates their whole patient, we'll wait and see the data stance. They can quite credibly say, look, the picture's mixed, we need more time. And this creates a sort of complex but temporarily stable situation for the U.S. dollar. It basically cements that higher for longer narrative for interest rates, at least for the time being.
So the market's kind of caught then between these two narratives. One says, watch out, inflation's reaccelerating because of tariffs and energy shocks, this could get sticky.
Yeah.
But the other, looking at core, says, no, underlying demand-driven inflation is behaving itself.
Exactly. It's a real tug of war in interpretation. And yeah, that definitely set the stage for some interesting market moves right after the release.
Okay, yeah, let's get into that. Given those conflicting signals, how did different corners of the market actually react? I imagine it wasn't straightforward.
Well, you definitely saw some initial whipsawing, some volatility right at 8:30 a.m. Eastern when the numbers hit. That's pretty standard. But what was fascinating was how quickly things resolved into some very clear, maybe even seemingly contradictory patterns.
Okay.
So first, foreign exchange, the FX market. The U.S. dollar index, the DXY, actually showed notable strength. The dollar strengthened against most other major currencies. It rebounded.
Even with the softcore data?
Even with the softcore data. The most striking move was USD JPY, dollar yen. That pair is super sensitive to U.S. interest rate expectations, or really the difference between U.S. and Japanese rates. It rallied pretty hard, hit a 15-week high, and started testing that big 148.00 resistance level.
Wow, okay, so the dollar got stronger. What about stocks? Usually a strong dollar can be a headwind there.
You'd think so sometimes, but not this time. In equities, U.S. stock indices, especially the tech-heavy NASDAQ, just took off. Both the S&P 500 and the Nasdaq Composite surged to new record highs, all-time highs.
Seriously, record highs. What drove that?
It was really fueled by what you could call a benign interpretation of that soft core CPI data. It basically calmed fears that the Fed might have to get aggressive again, slam the brakes. Plus, you had some positive company news floating around, like Nvidia getting approval for some chip sales to China, which just added fuel to the fire, especially for tech.
Okay, so stocks love the soft core. What about the bond market, the so-called smart money? Did treasuries focus on the hot headline or the cool core?
That's where it gets really interesting. The reaction in fixed income in U.S. Treasuries was significant because it was so muted. Yields saw very little net change. They didn't spike higher on that hotter headline number. And that tells you the bond market really placed more weight on the softer core print. They seem to agree with the equity market's take that the underlying trend is moderating, and this keeps the Fed on hold, not shifting towards hikes. They saw the Goldilocks aspect, not too hot, not too cold for the Fed's immediate plans.
Right, the Goldilocks interpretation. And what about bets on future Fed moves? Did those change much?
Very little. Looking at Fed funds futures, the market pricing for upcoming FOMC meetings was largely unchanged. A rate cut in July was already completely off the table, priced out. And the odds for a cut in September, they basically held steady, somewhere in that 50 to 60% range. So no major shift in the medium-term outlook for policy based on this report. It confirmed the status quo, really.
Okay, so that's the immediate snapshot. Stocks up, dollar up, bonds kind of stable. Let's zoom out. Beyond those first reactions, what are the bigger ripple effects, the second and third order consequences we should be thinking about?
Right, stepping back, that market interpretation, this Goldilocks view, soft core, is good for stocks. Firm headline keeps the Fed patient, which is good for the dollar. It really reinforces and actually widens the policy divergence between the Fed and other major central banks.
Divergence, meaning the Fed's doing one thing while others do something else.
Exactly. The Fed is now seen as firmly on this hawkish hold, not hiking, but certainly not rushing to cut. And that contrasts sharply with, say, the European Central Bank, the ECB, or the Reserve Bank of Australia, the RBA. Both of those are sounding much more dovish, signaling they're more likely to cut rates sooner because their economies look weaker, or they're more worried about downside risks. They're on different paths.
And that difference in paths, that divergence, what does it do?
Well, basic economics tells you that if you can earn a higher, safe return in one country compared to others, money flows there. So this widening interest rate difference in favor of the U.S. acts like a powerful magnet for global capital. That inflow provides a strong, you could say, structural bid for the dollar. Money wants to be in dollars to earn that higher yield.
Okay, so it pulls money into the U.S.
Yes. And a persistently strong dollar then has knock-on effects. It makes it tougher for export-focused economies like Japan or the Eurozone to sell their goods. It's like a de facto tightening of their financial conditions, even if their own central banks aren't raising rates.
Ah, I see. So our strong dollar can actually squeeze them.
It can. And that, in turn, might reflexively force their central banks to become even more dovish, maybe cut rates more aggressively than they otherwise would, just to offset the strong dollar effect, which, ironically, just widens the divergence further and potentially fuels more dollar strength. It's a feedback loop.
That's fascinating. A strong dollar creating pressure elsewhere. Now, what about inflation itself? Does this report change how companies won't think about pricing, especially with those tariffs?
Oh, absolutely. Think about it from a company's perspective. You've got these new tariff costs hitting your supply chain. If the stock market cheers when inflation data looks mixed, and the Fed clearly isn't about to hike rates to combat that headline number,
Then why wouldn't you pass those costs on to consumers?
exactly, the incentive to absorb those costs shrinks dramatically. If the market rewards you anyway and the Fed isn't punishing inflation, you pass it through. And that carries a real risk of leading to stickier, more persistent inflation in the months ahead, even if the core measure stays behaved for a while.
So that could keep headline inflation elevated.
It could. And what's concerning there, looking further out, is that this potentially sets up a really dangerous policy dilemma for the Fed down the road. It's a classic stagflationary trap scenario.
Stagflation. High inflation plus slow growth.
Right. Imagine a situation where headline inflation stays stubbornly high because of these cost push factors, but the economy starts to genuinely slow down, maybe core inflation stays low. What does the Fed do? Do they fight the entrenched headline inflation by hiking rates into a slowdown? That could crush stocks and risk assets. Or do they prioritize growth, let inflation run hot, potentially undermining the dollar and, crucially, their own credibility?
Wow, that sounds like a lose-lose choice, a really tough spot.
It is. And the current market calm, this sort of Goldilocks complacency, it really masks this building tail risk for, say, late 2025 or early 2026.
That stagflation trap idea is sobering. This whole dynamic, the market's reaction shaping the reality. It makes me think of George Soros and his theory of reflexivity. How does the market's perception actually influence the economic reality here? Is that playing out?
That's an excellent connection. Reflexivity is absolutely relevant here. You can see it quite clearly. The prevailing market bias right now, the dominant belief, seems to be that the Fed will ultimately prioritize growth, that they'll tolerate a temporary inflation overshoot, especially one they can blame on external factors like tariffs, rather than risk a recession by tightening too much.
And we see that belief in the market action.
Definitely. It's reflected in the equity rally. Stocks hitting all-time highs suggests investors aren't really scared of imminent Fed hikes. And it's reflected in the bond market's relatively calm reaction to that hot headline CPI. They didn't panic.
Okay, so the market believes the Fed will eventually be dovish.
Right. And here's the reflexive loop. Because the market acts on that belief, bidding up stocks, keeping financial conditions relatively loose, it actually supports the economy in the present. This very optimism reduces the pressure on the Fed to actually cut rates right now.
Wait, so the market wanting cuts helps the Fed not cut.
Precisely. The market's belief in a future dovish Fed allows the Fed to stay on hold, maybe even sound a bit more hawkish today, without causing a market meltdown. It's a fascinating feedback loop. And fundamentally, this loop is actually quite bullish for the US dollar in the medium term. Because the market's own optimism keeps pushing out the timeline for the very rate cuts it's hoping for.
Until something breaks the loop.
Exactly. That loop would likely only break if a new, powerful fundamental factor emerges. Something like a really sharp downturn in the jobs market, or maybe a full-blown trade war escalating unexpectedly. Something that forces a reassessment of that core belief about the Fed's priorities. And thinking about that belief, this CPI report really did shatter a simplistic narrative. The idea that, oh, inflation is picking up, that's automatically bad for markets, that got thrown out the window. Instead, we got this much more nuanced interpretation, like, okay, the right kind of inflation, the core stuff, that's behaving. While the wrong kind, the headline number, yeah, it's rising, but for understandable reasons, tariffs mainly, that the Fed can probably look through for now.
So the market sorted the inflation signals into good and bad buckets, essentially.
Kind of, yeah. And because the good kind core was soft, it removed the immediate fear, the tail risk, of an aggressive Fed stepping in. For stock markets, removing that big negative risk is a powerful positive. It was like a green light to keep buying, especially those tech stocks that are sensitive to interest rate expectations. That drove the decisive risk-on shift in equities.
Okay, but help me square this. Risk-on in stocks, yet strong USD in the currency markets. Usually risk-on means money flows out of the safe haven dollar, right?
You're absolutely right to flag that potential contradiction. That's what makes this current environment so interesting and, frankly, U.S.-centric. Typically, yes, in a global risk-on rally, the dollar might weaken as capital chases higher returns elsewhere. But what we're seeing now is different. The combination of risk-on equities plus a strong USD signals something specific. It points towards a U.S.-focused American exceptionalism type of rally.
American exceptionalism, meaning money flows into the U.S.
Exactly. Global capital is flowing into both U.S. stocks for the growth story, the tech leadership, and into the U.S. dollar for the yield advantage and relative safety compared to other slowing economies. This dynamic effectively acts like a vacuum cleaner, sucking liquidity out of the rest of the world. And that's structurally bearish, generally speaking, for currency pairs like the euro versus the dollar, euro USD, or the Australian dollar versus the US dollar, AUD USD. Even if global stock markets outside the US are doing okay, the dollar strength dominates.
Okay, let's zoom right in on those currency pairs then. Which ones are most impacted by this whole dynamic?
Well, first and foremost, you have to look at USD/JPY, dollar yen. As we touched on, this pair is arguably the most purely sensitive to U.S. interest rate expectations because the Bank of Japan's policy is basically anchored near zero.
So all the action comes from the U.S. side.
Pretty much. The whole game here is driven by the US dollar and US Treasury yields. And the carry trade, borrowing cheap yen to invest in higher yielding dollars, is a huge factor. So when the CPI report reinforces the idea that the Fed is staying on hold, keeping US rates relatively high, it directly strengthens the dollar's yield advantage over the yen. That provides a clear, fundamental tailwind, pushing USD JPY higher, testing levels like 148.00.
Makes sense. What about the euro? USD.
Okay, USD. This pair is fundamentally driven by that monetary policy divergence we talked about. The CPI report solidified the Fed's hawkish hold. Meanwhile, across the Atlantic, the ECB is sounding increasingly worried. They're concerned about the Eurozone's sluggish economy, the potential hit from tariffs. Markets are pricing in ECB rate cuts down the line.
So the gap in policy direction is widening.
It absolutely is. And that widening policy and growth differential is fundamentally bearish for USD. It weighs on the euro. You saw this play out even with global stocks rallying, which sometimes helps the euro. USD really struggled to gain any ground. It stayed stuck below that 1.177 over zero level. That tells you there's a deeper underlying weakness there for the euro against the dollar right now.
Okay. And the Aussie dollar, Aussie USD, that one's usually sensitive to risk appetite and commodities, right?
Yeah, Aussie USD is interesting because it has this dual sensitivity. It often acts as a proxy for global risk sentiment rallying when markets feel optimistic. But it's also very sensitive to commodity prices and, crucially, the policy divergence between the Fed and the Reserve Bank of Australia, RBA.
So how did the CPI report affect it?
It created conflicting drivers, really. On one hand, the risk-on mood in U.S. stocks should theoretically support the risk-sensitive Aussie dollar. But the resulting strength in the U.S. dollar itself acts as a major headwind. The strong USD pushes OD/USD down. Plus, the RBA is widely seen as being on a path to cut its own rates to support the Australian economy. That widens the policy gap against a Fed that's firmly on hold, so the net effect, it's likely continued ID/USD weakness or at best some really choppy, range-bound trading. The strong USD theme seems to be overpowering the global risk-on theme for the Aussie right now.
Okay, so we have this complex situation, diverging paths for central banks, conflicting signals. It really feels like we're at a crossroads. The source material laid out some potential paths forward using this really neat framework, almost like a tree of thoughts. Can you walk us through those scenarios?
Yeah, absolutely. It's a helpful way to structure the possibilities given the uncertainty. Let's think about three main branches on this tree. The first, and the one we see as most likely right now, is scenario one, bullish USD, the hawkish hold. We'd put roughly a 55% probability on this.
Okay, hawkish hold. What's the story there?
The core idea is the Fed leans into the narrative. They publicly emphasize the sticky headline inflation, the tariff effects, and use that as justification to stay firmly on hold, probably through the rest of 2025, Q3 and Q4. The soft core data prevents a market panic, but the persistent U.S. yield advantage just keeps driving steady demand for the dollar.
And what would that look like in the markets?
You'd see USD JPY decisively break above 148.00, probably targeting on 50.00, maybe even higher towards, say, 151.95 later on. At the same time, Euro USD would likely break below key support around 1.1630, heading down towards the 1.1500 area, maybe 1.1450. Confirmation signals would be continued hawkish talk from Fed officials, those currency pairs breaking those key levels, and Fed funds futures pricing out that September cut even more, maybe below 40% odds.
Okay, that's the base case. Fed stays put, dollar strengthens. What's branch number two?
Branch number two is the opposite. Scenario two, bearish USD, the dovish pivot. We estimate this at maybe 30% probability. Here, the thesis is that the soft core CPI we just saw, that turns out to be the canary in the coal mine. It foreshadows a much more rapid economic slowdown.
So the economy weakens faster than expected?
Exactly. Subsequent data, especially a really weak July jobs report, think payrolls under 100K, unemployment jumping up, forces the Fed's hand. They have to look past the headline inflation and start cutting rates preemptively to support growth, maybe as early as the September meeting.
And the market reaction?
A sharp reversal. The dollar's yield advantage evaporates. USD JPY would fail to hold above 148.00, turn lower, break below support like 145.70, potentially heading down towards 142.5 or even 140.0. Euro USD would rally, breaking through resistance around 1.1750, targeting 1.1830, maybe even pushing towards 1.200 if the Fed turns really dovish. Confirmation. A shocker of a jobs report, explicitly dovish Fed talk, and those key technical levels breaking in the opposite direction.
Got it. So hawkish hold or dovish pivot, is there a middle ground? The third branch?
There is, and it's messy. Scenario three. Sideways complex, the tariff trap. We assign this A lower probability, maybe 15%. The idea here is a market just gets stuck, paralyzed by the conflicting signals. Imagine upcoming inflation reports look frustratingly similar. Headline stays hot due to tariffs, core stays muted, economic data is erratic, maybe some strong numbers, some weak ones. Then the Fed. The Fed gets neutralized. They can't cut because of the headline inflation optics, but they can't hike because growth looks shaky and core is soft, their communication becomes muddled. The market probability for a September cut just hovers around 50-50. The result, the dollar lacks a clear driver and just chops around in a volatile range.
It's range-bound trading.
Pretty much. Maybe USD JPY gets trapped between, say, 145.50 and 148.50. EURUSD oscillates between 1.1600 and 1.180. No clean break either way. Confirmation would be continued splits in the CPI data, contradictory Fed messages, and currencies just failing to sustain breaks out of established ranges. It's basically policy paralysis reflected in the market. So weighing those three scenarios, our highest conviction, as I said, lies with scenario 1. The hawkish hold, that 55% probability for a bullish USD. Several things point us there. That muted bond market reaction is key. It suggests the big money, institutional capital, trusts the Fed's current stance for now. That reflexive loop we discussed where market optimism helps the Fed stay put, that's a powerful force. And fundamentally, the theme of policy divergence Fed on hold while others ease provides a strong underlying tailwind for the dollar that's hard to ignore. Honestly, the bar for scenario 2, the dovish pivot, seems exceptionally high right now. It would take truly significant, undeniable bad news on the economy.
Okay, so if the base case is hawkish hold, stronger dollar, how would you translate that into a potential strategy?
Based on that conviction, the strategic recommendation leans towards favoring USD strength, and the cleanest expression of that is often against the Japanese yen. So, initiating a long USD-JPY position makes sense. It benefits most directly from that widening US-Japan yield differential inherent in the hawkish hold scenario.
And how would you approach that? Key levels.
You could look for entries perhaps on dips back towards the 147.00, 147.50 area, or play a tactical breakout if it clears above, say, 148.20 convincingly. Risk management is crucial, of course. A potential stop loss might be placed on a weekly close below maybe 146.50, giving it some room. Profit targets, initially 150.00, that big psychological level, and then perhaps looking towards that 151.51.95 resistance zone further out if the trend holds.
Okay, that's a clear strategy based on the analysis.
Yeah.
But every analysis has risks. What do you see as the single biggest, most immediate threat to this whole hawkish hold long USD JPY view?
Without a doubt, the single greatest and most immediate risk is the next major U.S. labor market report, the non-farm payrolls, or NFP. A surprisingly weak jobs report is the one thing that could completely derail the hawkish hold thesis almost overnight.
What kind of numbers would do that?
We're talking about specific triggers. If headline NFP job growth came in below, say, 100,000, that's a big miss. If the unemployment rate ticked up sharply, maybe to 4.4% or higher, and if wage growth unexpectedly decelerated, that combination would be the kind of undeniable evidence of economic deterioration that could force the Fed's hand.
And that would shift the narrative immediately.
Instantly. It would swing the pendulum straight towards scenario 2, the dovish pivot. You'd likely see a sharp, aggressive sell-off in the US dollar, and that crowded long USD-JPY position would suddenly become the most vulnerable to a really violent reversal downwards. So yeah, we'll be watching all the incoming data, things like retail sales too, but that next NFP report, that's the big one. Laser focus on that.
Wow. Okay, this has been incredibly insightful. It really underscores the amazing nuance, the complexity hiding behind what can look like just a simple set of economic numbers. It's so clear how this Goldilocks contradiction hot headline, cool core, isn't just some academic point, but a real force shaping global markets right now. You know, this deep dive has really shown us how the very definition of inflation, what parts matter most, can almost be a moving target, even for the experts. So here's a thought for you, our listener. How does your understanding of these subtle shifts, these nuances in economic data, influence your own decisions, whether that's your financial planning, maybe career choices, or even just how you interpret the daily news headlines? Something to think about. Thank you so much for joining us for this deep dive.